Good day, everyone. Thank you very much for joining us in the session today, where we're going to be exposing the largest unrecognized risk to Canadian business. My name is Jacqui Jooste, and I am representing the Receivables Insurance Association of Canada, or RIAC, today. I'd appreciate it if you could hold questions to the end, and we'll be having a Q&A then. But sit back and enjoy the presentation. So on the agenda this morning, we are going to be having a look at trade credit insurance or receivables insurance and why this should be considered, what it does and what the benefits are, what it covers and the opportunity, and more importantly, the benefits to you, the broker. We estimate that less than 5% of Canadian businesses insure this asset, their receivables, which represents up to 40% of their total business assets. There is a bit of irony here as well, as of all asset classes, receivables are the most vulnerable to loss, are really the most likely to be affected by business cycles, and provides ultimately the cash flow for the business. And what we find is that even though this is such an important risk to cover, most companies have not secured coverage, and a lot of companies they're not even aware of trade credit insurance. We see this as an opportunity for brokers. With very little exception, most companies sell on what we call open account terms, allowing their debtors 30, 60 or 90 days to pay their account. They do so because they have to, otherwise their customers would buy from someone who would offer them credit terms. Most companies think nothing about insuring the other assets like their buildings, equipment, etc. But what about the receivables? After all, receivables are the source of the company's cash. We live and will continue to live, as we heard from the economic session earlier, in very interesting economic times where unpredictable cycles will occur. And just to give you some perspective as to how much a bad debt can impact a company, you can have a look at the example in the bottom right hand corner. So to make up for $100,000 credit loss, a company operating with a 10% margin would have to make an additional $1 million in sales to make up that loss. So you can see to cover just one bad debt really impacts the company severely. There is a misunderstanding amongst brokers, CEOs, CFOs and credit managers that the role of trade credit insurance is only to protect export sales. But this is really untrue in an economic climate that is prone to unforeseen events, unwise as well. So from our perspective, it's important for brokers to understand that the lack of receivables insurance coverage represents the biggest unidentified and uninsured exposure facing Canadian businesses today. But we believe therein lies the opportunity. So what is the solution? We believe that the solution is trade credit insurance. I'm not going to get into the intricacies of all the different forms of coverage available today, but in a nutshell, receivables insurance operates as a financial tool to enhance the cash flow of a business, bank financing, and even sales performance, while also protecting the balance sheet and the security of the assets. So security against risk and the mitigating of loss of sales revenue also creates peace of mind for properly insured companies. So why trade credit insurance should be on your radar? Today we have two objectives. So the first is to share a little bit of information about this product. So if you've never heard of it, to create that awareness. And if you have heard of it, to maybe share a little bit more information as to the importance of the product and why you should be offering it to your clients. We'd also like to emphasize the opportunity that this product holds, both from a financial point of view, but also from a client relationship point of view. And at the end of the session, my hope is that you will be curious enough to learn more about the product and make it part of your day-to-day activities. So for your business clients, trade credit insurance offers balance sheet protection. As we said, accounts receivable is typically one of the largest assets owned by a company, and most companies are currently not insuring this asset. 80% of a company's business normally comes through 20% of its customers, and therefore there's quite a large risk if, for example, one of the largest customers doesn't pay the policyholder or the company, and can actually impact the sustainability of that company moving forward. Trade credit insurance also enables businesses to manage their bad debt reserves and write-offs with greater certainty, and company can then take the excess bad debt reserves back into the income. And at the end of the day, it's really a good tool to improve cash flow. Open account terms on businesses all over the world is the norm. And I'm sure many of you have had clients with marine insurance and have issued cargo certificates where letters of credit have been involved. Historically, LOCs have been the norm for payment on many export transactions. But imagine if your customers were able to offer account terms for receivable insurance as a backdrop. It could provide an enormous credit competitive advantage for them, and not to mention cost saving, because historically setting up LOCs is quite pricey. The challenge for customers in this environment is knowing who to provide credit to and who not to provide credit to. So if you were looking to develop a market somewhere in Africa, most companies don't have the expertise or information in order to set up that open account. This is where insurance or big trade credit insurance companies come into play. They have enormous databases and information on companies all over the world, which can be very valuable to policyholders. So a trade credit insurance policy also has additional added benefits in terms of information. So as discussed on the previous slide, big trade credit insurance companies have huge databases of buyers all over the world. They also provide a third-party credit opinion, and this is obviously backed with a claim payment should this go wrong. In addition, trade credit insurance companies often act as an extension of a company's credit management department and adds value to their credit management procedures. Credit insurance companies also share and provide a lot of industry knowledge, economic knowledge in terms of sectors or countries or regions and from a risk perspective. And lastly, the company is able to accurately budget and forecast bad debt write-offs. Trade credit insurance covers two risks, so the first being commercial and the second being political. From a commercial risks point of view, this covers two areas, that being of liquidation or bankruptcy of the buyer, and that would include Chapter 7 and 11 in the US and CCAA in Canada. The second risk is protracted default, where the buyer does not pay within 6 months of the debt becoming due. It is important to note that disputes are typically not covered under a trade credit insurance policy. From a political risks point of view, various risks are covered, for example, transfer risk, government moratoriums, contract frustration, or civil turmoil. 90% of invoice value is traditionally covered by trade credit insurance in a typical scenario. This is quite a nice slide to use when you are in meetings with clients and maybe discussing challenges that they might be facing within the business. And these are some of the topics that could be raised, which may give an indication that the client would benefit from trade credit insurance. When we look at, for example, concentrations of risk, so if a company has a small number of large buyers that makes up their accounts receivables, that's often where banks are wary of lending in this kind of situation and may not give full credit when margining accounts receivables. And similarly, country concentration would be where a company has a large amount of its receivables situated in one country or a high-risk country, for example. So these are all things that you can listen out for, which may give an indication to start the discussion on trade credit insurance with that company. So what is the opportunity? What are the benefits for brokers? We believe that there is significant opportunity for this product in the Canadian market. It is estimated that under 5% of companies or eligible companies for this product are actually insured, and this leaves an enormous opportunity to grow this product in the market. In Europe, where it's a more mature market, we estimate penetration rate 40% or above, and this is where companies realize that it's really good from a corporate governance point of view to have this product in place. So as you can see, just as just an example of figures, if we were to increase the penetration rate by just up to 12%, the additional revenue from a premium perspective that can be earned in the Canadian market. So from a global market share perspective, there are three dominant major players, being Allianz, Atradius and Coface, and the balance of the market share being taken up by numerous smaller players in various countries around the world. What is really interesting to see is that even though this product has been around for quite a long time, it is still a growing industry, reflecting a 15% growth under the period of measurement globally, and a strong growth in the Canadian market of 21% under the period of measurement. Here in Canada, we have 7 active and licensed insurers who underwrite receivables insurance, and I'm sure you do recognize a few of them. It is widely recognized that EDC is the market lead, and they have a strong government mandate to support and grow Canadian export business. But there is a vibrant and highly competitive private sector market as well. This market works very much like traditional P&C, in that all of the insurers work with brokers. Some of them do have direct sales force, but there is a good coexistence between agents and the existing broker network. We believe that the benefits of this product to brokers are numerous. So for us, it really is an opportunity to bulletproof your book, enabling you to provide more value to your clients and expertise-driven advice. It also is an opportunity to build credibility with your client and enhance the relationship by sharing product knowledge, keeping in front of the client, being seen as a consultant to the business by senior management, and developing relationships with other management layers within your client. At the end of the day, to handle all the client's P&C needs. So let's talk commission. So this is just an example of a typical broker commission structure for a normal small to medium-sized business, where they're reflecting $12.8 million in sales and a premium rate of 0.25%, which would equate to a net premium of around $32,000 per annum. And broker commission is typically 15%, which would equate to annual commission of $4,800 for this one client. That almost brings me to the end of the presentation, but I'd just like to provide a brief recap. So what is the risk? The risk is the client's receivables, which are exposed to loss, especially in this ever-increasing risk environment of uncertainty and global pressures and global risks. The solution, we believe, is receivables insurance, or otherwise known as trade credit insurance. And this type of insurance protects the largest asset owned by a company. It covers commercial and political risks and enables you as a broker to bulletproof your book, to earn commissions, and to be the best partner you can be for your client. What I'd like to do to just end off is share a little bit about what RIAC is. So who is Receivables Insurance Canada? We promote and we build awareness of all facets of receivable insurance throughout Canada to all current and prospective parties that we believe could benefit or do benefit from the use of receivables insurance. We are highly invested in educating companies, banks, and other third-party influencers on the benefits of the products that we offer. And it's an association of people and businesses that are interested in the promotion of receivables insurance and are interested in the growth of Canadian economy and Canadian businesses. We in no way promote one carrier's products over another, and we really are focused as growing the industry as a whole. We are very happy to support and to answer any questions that you might have. Thank you. That brings us to the end of our presentation today. Thank you very much for your time. I am very happy to answer any questions you may have.